Hey everybody, this is Chuck Sierk with REIMG Lancaster. I'm here with my friend Chad Gallagher. Chad, tell us a little bit about yourself.
Yeah, it's great to be here. I'm super pumped. So I'm one of the co-founders of Slatehouse Group. We're a real estate company. We do property management across central Pennsylvania. We also have a home repair division, plumbing, HVAC, and electric. Actually, I co-host a meetup in Lebanon as well as being heavily involved here in Lancaster. And yeah, we're all about buy and hold investing. We're investors ourselves.
That's perfect.
Yeah.
That's perfect. So I'm not a buy and hold investor. Right now it's a seller's market, so the market's telling me buy and sell. But I know there's a lot of people that they're thinking about building wealth and they want to buy their first investment property. How would you go about telling somebody this is what it takes to buy an investment property to hold for the long term?
Yeah, we get asked this all the time, Chuck, and I usually say break up into three parts. Upfront investment. What's it going to cost you to kind of get into this property before anything else starts happening? Then two is kind of on a monthly basis. What's your cash flow going to look like? Hopefully positive, right?
Yeah.
And but when you take everything into account at the end of a month, what's that cash flow look like? And then the third part, which sometimes people forget about, but what is this asset going to do over time, right? And if you eventually sell it, you refinance it, whatever, what's it look like, 15, 20 years out?
Okay, so they found a property. They want to go take a look at it. How do they go about evaluating that house as an investment?
Absolutely. So kind of take you through a couple different things, really on the upfront investment side. So how much money are you putting into this property before anything else happens? So the first thing we like to look at is, what would this property appraise for, right? So not what are you going to pay for it, maybe not even what would someone else pay for it,
right?
But if an appraiser came through this property, what would it appraise for? That's really important because as you kind of start going through banking and getting financing this property, a lot of times that's a key number to look at.
Yeah, for sure.
Then we look at, price, right? Well, what are you going to acquire it for? Oftentimes this is actually the most important thing people really concentrate on. It's important, it's not the only important thing, right? But definitely price matters. And we like to think about, against the appraised value, what is the price to acquire it, and understanding the difference between the two. The bigger that gap, it's a good thing over time. I'll explain that later. We talk about financing. So it's interesting. Financing, a lot of people don't correlate that with a property as being a deal or not, but we actually think it is something that really should be considered as part of looking at a property. How are you going to finance this property? How much money are you going to put down? How long is the loan going to be? How long will the loan be fixed for? What's your interest rate? I bring up things like this because if the interest rate is 10%, 12%, this property might not actually be a deal. But if you're buying it at an interest rate like you might see today at a 4.5% interest rate, it might be a deal because your mortgage is going to be less. So, I take that into consideration. The next big item is initial fixing costs, and this is a tough one. This is, it is, you could be doing this for a long time and still not get this right. But this is really, you go walk through a property, how much money are you going to need to put down before it's all rented out, right? This covers everything from drywall to painting, big ticket items like roofs. What's needed to get this thing fixed up. Next is closing costs, right?
Yeah,
so
sure.
This is kind of tied to financing, but I put it in here because closing costs can be negotiated over time with bank. With a bank, you can get a lower closing costs as the partnership's grown with them over time. Maybe the seller will even help finance some of those closing costs for you. So that's a big deal. And then the last is really, are there any costs to fill the vacancies, right? So, this one I think about, if there's two open units, we use as a rule of thumb between half of 1 month's rent and a full month's rent is a good kind of barometer of what to think about. That means you're going to be charged to find a tenant. Now, if you're finding it yourself, that doesn't count, right? You're not going to probably charge yourself, but and we at Slatehouse, just to give you kind of an idea, we charge half of 1 month's rent to find a tenant.
Okay, so let's talk a little bit more about the fixing costs.
Yep.
Right? In fixing costs, so I buy a house, I'm fixing it up for someone to purchase and they're going to move into it and live there as their own residence. This is a little different or do you do the same level of renovation?
Yeah, it's a great question. I think if there's one thing we see with new investors, they want to put more money into the property than it probably needs. It's a general rule of thumb. Obviously, high-end investing, right? So you're getting, penthouse suite. That's a little bit different. But assuming you're getting either a low-end property or middle of the road, this is not going to be the living room that someone's going to have dinner with their family for the next 30 years, right?
Mm-hmm.
So the amount of money needed, in particular cosmetic stuff, things like fixing up trims and painting, typically we like to say put in a little bit less than you think. That's what in our experience is, don't think about fixing this up for your own self, but it's a rental property and renters require just a little bit less usually than what you might have for a nice house that you want to flip.
Sure. So figure out what it's going to be appraised for. Compare that to what the purchase price is going to be. Don't forget that you've got closing costs. There's a cost to buy it. There's a cost to fix it, and there's cost to fill if there's any vacant units. Right?
Absolutely. And the other thing I would just say is that something to think about is, can you get the seller to give you some money back towards closing?
That'd be huge.
And this gets into even seller financing. But we've seen when we first started investing, a lot of people told us you're limited to maybe 2% back at closing or all these different rules. We found that especially as you grow as an investor, you work closer with direct banks. A lot of these rules aren't really rules, and if you talk to the right people, you get some relationships. A lot of these things they're very fluid. Something like seller financing, if a seller is willing to put down a little bit of extra money, and kind of hold that back, that can really decrease the amount of money you're putting in up front.
Sure. So what you're telling me is that it really comes down to relationships and building those together with the seller as well as with the banks. It's
100%.
very important for success as an investor.
Yeah, 100%. I think, you think about real estate as just kind of buying property. You don't think about the relationships that really matter, but it turns out it's really important, and those relationships can really help you over time.
Yeah. So if somebody's buying this property, they're looking for a long-term investment. They want cash. They want to keep putting cash in their pockets every single
Hopefully.
month.
Right.
So tell us about how you figure that.
Yeah, so let's start off with what is one of the more tricky ones, and that is the total rent. Right? So what is this thing going to rent for? Now, one mistake I see all the time with investors is they take the rent as what is it renting for today. And, anyone who knows for a while will tell you so often the tenants who were in there before, maybe they weren't paying rent every month, right? Or, maybe they leave in 2 months and now you need to find new tenants, or maybe they're not paying enough, right? And so we really think about, when we talk about total rent, it's what should a property rent for? What is the market value of rent? And we're going to do a whole video section on that because it is not easy to nail that down. We have a tool on our site at slatehousegroup.com. There's Zillow, there's other stuff, but we'll cover a whole video on rent. But that's kind of the first one. The next is missed rent. So there's really a couple things that kind of go into this. One is someone being evicted, right? So maybe you missed that rent that way. The second would just be, tenant gives notice and maybe the place goes vacant for a month or two while you're fixing something. Whatever it is, it's probably not zero, right? There's probably going to be some missed rent in there. We usually say to assume 5%.
Okay.
As a rough number, assume 5%. Really nice places, high end, 2 to 3%. Lower income, assume maybe something closer to like 6 to 7%.
Yeah, a lot more to manage.
A lot more to manage, just a lot more turnover.
Sure.
Look, you're probably not going to collect 100% rent every month, right? And so we really look at this. This is two things. This is maybe a tenant getting evicted, right? You're going to have some missed rent there. The other thing is just turnovers, right? So, someone gives you notice. You're not always going to have a tenant ready to fill that place right after you're done. So we usually say as a rule of thumb, assume about 5% missed rent over the course of the year.
Okay.
Higher end places that have been stable for a while, maybe assume 2 to 3%. Lower end, 7 to 8% is probably a good gauge, and you'll just kind of gauge that as you go along here.
A little bit more to manage.
Yeah, a little more managing, just more turnover.
Okay.
With turnover comes higher vacancy costs.
Less days with people living in the house.
Exactly.
Right.
Exactly. Yeah. So then next we talk about expected maintenance on a yearly basis. Not an easy one to kind of put a number against. The way we look at this is kind of an amount of about $1,000 to $1,500 for the property, and then another $500 for every unit. So just give you an example, you got a 3-unit property, we would say, yeah, probably around $2,500 a year for maintenance. Now, that number is hugely variable, right? So you just get done putting all the best stuff in here. The place is in perfect shape. The HVAC is brand new. Everything is perfect. It's not going to be that much, right? It's going to be less.
Right.
On the other side of things, you pick something up, you put very little into it up front. It's in rough shape in a rough part of town. It's probably going to be more, right? But that's the way to think about it is, about, 1,000, maybe 1,500 plus another $500 per unit. It's a good rule of thumb for kind of maintenance over the course of the year.
Okay.
Next one is utilities. Now if it's a single-family home, the tenant's often paying for utilities. Makes things easy. The way you're going to kind of work that out is usually you or the management company will get billed, but then you'll just push that right onto the tenant to pay. But for multi-units, it's a little more tricky, right? So for a multi-unit property, oftentimes things aren't broken out. And so you just want to understand water, trash, gas, electric, oil, kind of go through each, but water, it's usually about $45 to $50 per unit. Reading, a little more expensive.
Okay.
Right? I don't know what's going on in Reading, but we assume about $60 per unit in Reading. Trash, we assume about $60 a month, give or take, for the entire building.
Okay.
Right? So 3-unit building looks a lot like a 1-unit building there. And then gas, electric, oil, this is tough. Slow down here. When you do your analysis, really take your time and kind of take each of those one by one. Who's paying for heat? Who's paying for the electric? If it's electric baseboard, hopefully it's broken out and the tenants can pay for that themselves. But if you're paying for it as the owner, that could be a big number, and you really want to take your time and kind of estimate that, of what that should be. And don't just take the owner's word for it. So often we see that number is estimated a little too low.
Yeah.
So
Well, they want it to look more attractive,
right
to you as the buyer.
If you have a 3-unit property and only 1 unit was filled, something tells me your gas is going to be a little bit higher when you have all 3 units filled.
Yeah.
That's
Now, would you recommend somebody to actually go through the process to separate the utilities, or does that get into?
It's a loaded question. Yeah, it's a loaded question. So, what there are investors that fall on either side of this. Some people insist on this. First thing they do is break out utilities. Some super smart investors who do this for a long time. Other people fall on the other side and they don't break it out. We see both sides of the argument. For us as investors, we do not break it out.
Okay.
We don't find that the cost of breaking it out is worth the long-term gain. But I see both sides of it. I think it's an interesting question, and I think it's really on a case-by-case basis. What's it going to cost to break out is obviously on a property-by-property basis and has a huge play here. And also kind of, what does that cost look like? What are you paying for in those utilities? Because that helps kind of dictate what your upside could be.
Yeah, so you might put that, if that was your plan, to separate the utilities, put that into the fixing cost in the first.
Yeah, absolutely. The other thing you could do is, if you want to have less fixing costs, right, you want to make some money over time, you could run this thing for 2 years, 3 years, get some money in your pocket, and then reinvest that money to break things apart. We see that sometimes. I will say this: there's no question the value of the property does go up a little bit once you've broken things out.
Okay.
Because some investors only want to buy things that are broken out.
Exactly.
So there is more value there. Cool. So next is management fee. Now, some investors we talk to say, well, I don't need to put that in my model. I'm going to manage this thing myself. My opinion here is that most investors are probably not going to manage the property for the rest of time themselves.
Sure.
At some point, you're going to want to move to Florida, right, or Tahiti or whatever, right? And
that'd be nice.
Right, and you're not going to want to be, collecting rent every month. So our opinion is factor that in, just give you a rough gauge of what to expect for management costs. We see anywhere between 6 to 10%
Okay.
in kind of a monthly management fee. To give you an idea, at Slatehouse Group we charge 6, but anywhere between 6 to 10 is a good rule of thumb. And then also you're going to see a leasing fee. This is finding a new tenant. We're going to charge about, you're going to see anywhere between half a month's rent and a full month's rent to find a tenant. We charge half a month's rent, but that's just kind of one data point. And then usually assume you're probably finding a new tenant once every 2 years.
Okay.
So all in, you're looking at a management fee when you include all that stuff. 8 to 11% is probably a good rule of thumb there.
When you stack them on
That's
one
exactly
top.
it. That's exactly it. Taxes. So some people say, "Oh, this is simple. Just pull the taxes off, the MLS or whatever." The one thing I get worried about with taxes is what the property's tax assessment is today might not be what it is in the future.
Okay.
Right. So we see this sometimes. Property sells at a tax sale, for example, super low tax assessment. Property's run down. Someone then comes in, fixes it up, makes it look much nicer, adds some unit to it, whatever, flips it, and now, if someone comes through, the next time the tax assessor comes through, that property will probably not assess the same tax value.
Yeah, for sure.
Right? So we just say, just be a little cautious when you're looking at outer years in the tax. Don't always just assume it's going to stay constant. I know in Lancaster here, we just had the tax assessment go through, and some people were shocked at how their taxes increased, right?
Mm-hmm.
And I think, just get in the back of your head. Last one is the debt service and mortgage, right? So, and again with this one, a word of caution, right? And that is, so for most commercial loans, you're going to see about a very typical, so a 20-year loan, first 5 years fixed. Right? It's very, very kind of, there's all sorts of ways of doing this, but that's the most common way. So that means years 6 to 20, that interest rate is going to be variable, pretty close to what prime is.
Okay.
Right? So the reason I bring this up is because right now we're living in a very low interest rate economy, and most people would probably agree that at some point in the future the interest rates will increase.
And it's bound to happen, right?
Right. So the only thing I'm saying here is probably put that into your model, thinking that outer years your mortgage is probably going to go up.
Yeah. Okay.
Right. So that's kind of your ongoing cash flow things to consider. Some of these will take you minutes. When you want to start doing this over time, it'll take very long. Other things are going to take some time. I mean, estimating rent is, you're going to have to call some people and look at the different data points.
Okay, so you've taken a look at the property, you figured out what you need to do to it, what type of condition it's in, what it's going to appraise for, what the cost would be, so you're kind of figuring out what the purchase would look like. And then you're figuring out how much money you can put into your pocket.
Right.
And are you done there?
Yeah, so one more stage, and that is the future value of the property.
Okay.
Right.
Mm-hmm.
So now those flippers out there, right? They're really, this is what you live and die on, right?
Well, future value is once I buy it and I fix it, I'm going to sell it, and that future value is 3 to 6 months
Right.
in front of you.
Right. For a buy and hold investor, that may be. In our models, that's 20 years out.
20 years.
Right.
Okay.
So, I don't even know where I'm going to be in 20 years, right? Let alone what the property's going to be worth. But it's not easy to predict. What we typically say is err on the conservative side.
Okay.
Right?
Mm-hmm.
Buy and hold investing, more often than not, is not a home run game. It's a bunch of singles, and we say err on the caution side. We usually assume a 3% appreciation every year for our investments over a 20-year period.
Yeah, so if you look at some of the charts and the averages over the, comparing it to stock market, they have an average gain, and for housing it's very similar in this area to a 3% appreciation.
That's
yes,
right.
There's ups and downs, but
That's right.
normalizes around 3%.
That's right. Now, look, if you're investing in a really up-and-coming area, I look at something like right now where kind of Lidditz is, right,
Mm-hmm.
in Lancaster County, and really Lancaster County as a whole is seeing a ton of appreciation right now.
Mm-hmm.
Right, so I'll tell you, in the last 4 years, you did not see a 3% appreciation in Lancaster County.
No, it was significantly.
But I always get worried about anyone who's expecting more than that, because I always say, what's over 20 years, what's it going to look like? If in 4 years we see a dip, and then a couple of years we see an increase. These things, they go up and down, but what nice thing about buy and hold investing, you're investing 20 years out. We should say 3% is kind of what you should expect. And then we always say, so what's your end game? So I say 20 years, but maybe that's not your end game. Maybe you want to sell this thing in 5, right? That's fine. So just take that into account into your model. In 5 years, you want to sell it. If you're going to sell it, right, when you sell it, 2 things, right? You're going to pay some tax on the sales price, the difference between what you sold it for and what you bought it for. But the other thing to keep in mind is typically you're paying a sales agent to sell that, right? So you're paying some closing costs, you're paying some taxes, and so we actually like to figure that in, that if you were to sell that in, let's say, 10 years or whatever, you're not getting that whole value right there. That's kind of option 1. Option 2 is, we often say, what if in 20 years we don't want to sell it? Let's say we pay off the loan, maybe we want to refinance it, right? Not a bad way to go, because you don't pay any tax on the refinance. You maintain the asset. You can pull out, 50 to 80% of
so you can take that cash,
take it out, pay
and
no,
reinvest it, or
exactly
do what you need.
Exactly.
Mm-hmm.
And so, that's another way of looking at it. But either way, look at that, and that we usually plug that into. In our models, it's in year 20, but however you kind of think about it, just to make sure you account for that, because you are going to see a noticeable increase to your returns by putting that in there.
Very good. Very good.
Cool.
So, we've gone through how to evaluate it. We've gone through from a cash flow perspective, and we've gone through future value. There's a whole lot more, especially we talked about some of the financing. You talked a little bit about seller financing, and there's a lot of things that we can get into, especially, how do you calculate rents? There's a lot more that goes into this.
Yeah. So I would say, this is kind of like round 1 of this whole education thing we're going to do. We're going to do a whole bunch of videos. We're going to cover one specifically on rents. The other thing I didn't even talk about is, so ultimately you got all these variables. Now, what does it mean, right? There are probably people sitting there saying, yeah, Chad, that's great. I've now got a bunch of numbers on my page, but what doesn't do anything for me, right? And so we're going to do a whole next section on, IRR versus cap rate versus cash-on-cash return. I'm going to really dig into that to then say, hey, these variables we just talked through, let's put them into a model and help you evaluate, go or no go. Right?
Okay, very good.
And so yeah, we'll talk through much more stuff, but we just kind of want to start somewhere, right? Where do you even start when you're valuing a property? This is what we look at. By the way, there's a lot more stuff you could look at.
Oh, absolutely.
Right? Some investors, for example, will tell you they would never invest in a flood zone, for example, right? We would just never do it. It's a game off. Would not do it. For us, we say, well, investing in a flood zone is not the worst thing. You're going to have to pay some insurance on that, and by the way, that's actually one thing we should have talked about is you are going to have yearly insurance on the property, assuming you have financing. The banks can require some insurance, but on our perspective, we're not completely anti-flood zone. Some people are, but if you're going to invest in a flood zone, assume a slightly higher yearly insurance rate.
Yeah.
But insurance is something that you probably want to have in your model as well. It's a little easier usually to figure out because most people, once they've been doing a few properties, can kind of quickly come up with what your insurance would be.
Awesome. So let's get back together. Let's keep this going because there's a lot more to it, and I'm sure that investors here in Central PA are really excited to be able to learn more about buy and hold investing. I know I am. Yeah. I'm going to be learning right here alongside you because that's not my game. That's not what I'm doing.
And I would just say, let us know. What do you want to hear? Reach out to us. My email is chad@slatehousegroup.com. If there's certain education topics you want to hear more of, we'll do it and we'll cover it and we'll dig in. We're investors. We're also a property management company. We do home maintenance. So this is, for better or worse, what we do every day, and we like talking about it.
Exactly.
All right.
Exactly. So connect with us right here below this video. Go ahead and put in some comments. If you have more questions, if you like what you saw, you want more, if you have ideas for some specific topics, connect with us. We're going to be here. We're going to do some videos, but we're also going to, what do you say? Why don't we go live?
Go live. I'm in. Let's
go live. So that way we can answer your questions directly. If you could, go ahead and put some comments below this video. We're looking forward to connecting with you and building up the group We've got a great group of investors here in Central PA from Harrisburg, York, Lancaster, Lebanon, Berks County, Chester County. We've got a good thing going, so we're really excited. So we'll see you soon.
Bye, guys.